Hello, everyone. Welcome, welcome. We're so excited to have you here. Please hang tight for just another minute while we let everyone join up on the webinar. Thanks so much. Hello, everyone. Welcome to the State of AI in Banking, brought to you by Ai4. My name is Patricia Elise, and I'm really excited to be here with you guys today. We have an awesome webinar prepared for you today with some amazing panelists. Before we jump in, just one quick housekeeping item. In order to ask questions throughout the event, please make sure to use the Q&A feature. This makes it much easier for us to find your questions so that we can send them over to the panelists. Without further ado, I would love to bring our panelists to the virtual stage, and I'd love to hand it over to our moderator, Michelle.
Thank you, Patricia, and welcome everyone. I'm Michelle Bonat, your moderator today. I head up AI innovation for digital JPMorgan Chase, the largest US bank, more than 60 million households, 55 active digital customers. However, these opinions are absolutely my own. And in terms of perspective, what I do is I work on tech futures, building AI tech for the next gen to serve our customers in both Chase Consumer, JPM Wealth Management, and business banking. So a bit of level set. Here we are in May 2021, after more than a year through a pandemic. And as we think about this and reflect where we've been and where we're going, here in the US, we're improving somewhat. I know I have a kid upstairs doing online school, but other areas such as India are still having a difficult time. So as we think about where we are, what we'll touch on during this hour are a few things. What are the opportunities for AI banking? Share some examples, some of the challenges in making AI successful in this, banking, financial services, this highly regulated industry. Talk about even, we'll touch on the new regulations coming out of Europe and how that might filter to the US. And then after this past year, discuss how things have changed coming out of the pandemic, and then take us into a look at the future. So today we have a panel of experts, a really interesting combination. We have consultants, product marketing, risk management, and me, an executive practitioner of AI. So without further ado, let's introduce our panel, starting with Jacob.
Well, thank you, Michelle, and I'm honored to be here. First, any of the views I share today are those of mine and not necessarily those of Regions Bank. I am the head of model risk management and validation at Regions Bank. I've been in that role for 7 years. AI risk management rolls up to me, as does model governance and model validation. And so AI risk and the validation of AI models are extremely important to our team and to our bank. And today we'll talk a little bit about how to have a good AI risk management program, and in particular what we've done here at our firm around AI ethics, around AI fairness, around AI interpretability, and overall the validation and governance of AI models at a modern bank.
Pamela, go ahead, please.
Yeah, thank you, Michelle. Really excited to be part of this panel. I'm Pamela Negosanti, and I'm leading the sector strategy for Expert.ai, which is a company specialized in artificial intelligence and in particular in natural language understanding, which is a branch of AI. So the capability to read a text in a document exactly as a human is doing. That's kind of our mission. And I'm happy to contribute, providing my experience in terms of real life use cases and success stories in terms of the appetite throughout the world when you combine AI and financial services.
And Pamela, I know you're sitting outside the US currently, so we absolutely welcome your perspective on that as well.
Yeah, exactly. I'm based in Italy today, waiting to move to the US, but yeah, so happy to share different geographic perspective too.
Great. Lakshmi.
Thanks, Michelle. Hi, everyone. It's a pleasure to be part of this panel. I'm Lakshmi Randall. I lead product marketing for Datatron. Datatron provides machine learning model operations and model governance platforms. So I'm really looking forward to our conversation around how to take models from experimentation to actually operationalizing and scaling and realizing business value, from those machine learning initiatives. So happy to be here. Thank you.
Welcome. And Wayne. Wayne, we can't yet hear you.
Thank you. This is the mute effect. I'm a model validation manager, Wayne Shoumaker, in Wells Fargo's corporate model risk group called Seymour. I've been in Seymour for about 8 years and witnessed a significant change in model risk management starting at around 2018 or 2019 due to the assumption of AI ML models and regulatory interest, which began at around that time. Model types have moved it around in my team over time, but the models that are currently managed in my team tend to be, but are not exclusively AI and ML classification and scoring models like fraud models, chatbots, and other NLP-related surveillance models. This is a good opportunity to talk about prospects like developing change management routines and new methods in model governance. Pleasure to be here.
Absolutely. Well, welcome everyone. And Patrika, if you could kick us off with our first question.
Sure. So the first question is warm-up question. Banking and AI, a perfect match or a breakup waiting to happen?
Great. So Jacob, kick us off. Let's do a quick roundabout on this.
Great. Thank you, Michelle. In banking, we're seeing a growth of AI models. In many institutions, it started in the financial crime space, a variety of machine learning models in fraud and cybersecurity and anti-money laundering. It grew into marketing and customer next best action and propensity to spend. And now, of course, it's growing into credit decisioning, as well as many other uses. And so I think it is a good fit. However, what's extremely important, and we've learned here at our bank, is the partnership across risk management, whether it's on the security aspect, on the privacy aspect, on the ethics aspect, on the fairness aspect, on the interpretability aspect, on the models in the cloud and some implementation issues there, on the models kind of embedded within IT application. It's hard to find for a variety of reasons to be successful. And so I wouldn't say it's perfect, but to use AI in a safe and ethical way, the partnership between model risk management, IT risk management, compliance, legal, many operational risk, other parts of non-financial risk are really going to be so important. And so to really be a perfect use or a really good use of AI in financial services, you of course need good first line defense, but a really, really integrated and coordinated risk management structure, especially between model risk, IT risk, and compliance.
Got it. All right, so let's each weigh in on this. So banking and AI, perfect match or breakup waiting to happen? Pamela, what is your thought?
Perfect match, definitely. I'm an optimistic by design, but I think it's kind of, perfect marriage, and that there's no perfect marriage, right? But I think that the two words can really complete each other and can benefit both directions. To me, it's kind of the relationship is at the beginning, right? And the two words are getting to know each other more. And the more they will know, the more they will work together and collaborate. So to me, it's a perfect match, but it will become more and more productive in terms of collaboration in the upcoming years, because there has been a lot of hype initially, and financial services for sure has been one of the industry that adopted early if compared to others. And I'm just thinking about insurance, which is to me like 10 years behind, just to put a number there. So growing relationship, but definitely a match. And I second Jacob's comment related to what I call the ecosystem to make AI successful to serve the industry, right? So it's not enough you have a great model or you have a great technology. You have really to prepare the environment accordingly.
Right. It takes a village, right? Absolutely. Lakshmi, what is your perspective?
Yeah, I concur with our panel perspectives thus far. I mean, we are in the AI-powered digital age. It's not only a perfect match, but it's extremely critical for banks to create that unique differentiation, right? And to be competitive in the market. What value AI will add is improve the operational efficiency, right? Engage the customers with more personalized recommendations. And whether it's fraud detection or cybersecurity, handling some of those use cases in an efficient manner, and automation or semi-automation, right? It will help the human, assist the human with the decision making. There's still human in the loop, but it will optimize the process of decision making, right? So there are so many ways AI can contribute to banking. But what's important to remember is it's not just the technology, right? So it's people, processes, technology. So all those pillars are extremely important. So the banks need to take AI from R&D type of use cases or simple experimentation to actually operationalizing and scaling those use cases for multiple business use, multiple business use, and actually realizing value from those use cases, right? So if you're not realizing value from those use cases, then it's not going to help the bank to get to the next level or gain that competitive advantage. But in order to do that, they need to develop a level of maturity. They need to make sure there is good data quality, right? Because your predictions are as good as your data. And also a culture that has an efficient operating model, which facilitates collaboration between IT and business. I've been in this data analytics industry for a long time. Data governance, tend to be more like book oriented than really be able to scale within the organization. So it's more passive than active. So the governance has to become active. So it's embedded part of the business processes or embedded within the business users workflow. So it's not disconnected from what the business is trying to do, right? So all of those things are important. And something to keep in mind that with the AI and ML, if models were trained based on the past data, for example, with COVID, the models calibrated before COVID with the past data may not perform well with the new data as the underlying assumptions change. There's data drifts, there's mathematical drifts happening. So it's important to continually monitor these models and optimize these models, make sure they're trained on the up-to-date data, right? So all of those things are going to be important for achieving that success or taking the business to the next level, or realizing any monetary value or financial stability within
Right, absolutely. I mean, what really resonates with me in your comments is, a model doesn't help a customer until it's deployed, right? A model sitting on the shelf helps no one. So Wayne, do you have a perspective on this?
Well, I guess
banking and AI, a perfect match or a breakup waiting to happen?
Yeah, this is kind of collateral to what Lakshmi was saying, because I think AI is best characterized as just another tool to manage risk, operations, and sales and marketing. It comes from the fulfillment of current needs. And so the match will really never be perfect, because the need will, there will be always that demand. Specific needs require specific tools. Cybersecurity and fraud are good examples where fairly new methodologies were developed or enhanced to meet the need. At a very general level, there isn't much conceptually different from the tools that have been in place. But a related question is, can policy which links bank activities with the regulatory oversight keep up with the demand and supply of AI and ML methods? And this is actually broader than AI versus no AI. It really is. It's indicative of the bank's responsiveness to growing and increasing, increasing it and more rapid change in needs.
Right, for sure. And I love it that everyone has so much to say on this. So many different ways we could go. So with that, let's go to our second question. If Patrika, you could kick us off.
Sure. So the next question is, what opportunities does AI provide when it comes to banking? And we'd love examples, please.
Right. So Pamela, let's start with you here first.
Okay, so there's a lot of potential examples in application, and I will try to group and cluster some of the examples that I'm more familiar with, and they all fall under what I call the customer obsession, and that's more than the customer centricity, right? Because there's really a lot of care about customers in the way banks are engaging with customers, new way, new model. Wayne mentioned chatbot or cognitive advisor, new ways of really automating the interaction that are speeding up the process. So that's definitely very relevant, not only in terms of operational efficiency, which is always one of the main benefit of AI solution. Semi-automation was mentioned before. But if we shift a little bit the perspective, that's really offering a better customer experience. You're dramatically reducing the processing time, and you're creating retention, basically, or you're decreasing potential churn rate. And not just because you're fast, but you're just removing potential frustration. We all, as customers, are getting frustrated if we not receive the right answer, or if we receive delay in getting the right answer. It's not that we call a customer center because we feel alone and we want to discuss. We want a problem to be solved. And if that's via chatbot or via a website or via an app, we don't care, or personally, I don't care, right? So I really want to have the problem solved. And all different application of AI could really help in speeding up and reducing the delay and the processing time. So that's definitely a plus in one of the main area. The second one that I think is related to that, still in the customer area, is that if you know better your customer, right? So think about an omni-channel strategy, where you're not just automating a piece of the relationship you have, but customers are communicating to banks and to financial services with different ways. There's the app, there's the email, there's the call, there's the chat, there's a form on the website. And if you're trying to find common ways to really have a better picture about the needs of your customer, broadly speaking, and also you can find recurring pattern that can help you in predicting things. So, and there's like a lot of relevant use cases in the, I don't like to call it sentiment because it's a little bit more than sentiment, but it's like the emotion and attitude. Really, if you analyze the way people are using language, you will find out in terms of the cadence and the words they're using a lot to really prevent some bad situation or breakup, for example. An example of a success story we had was that a customer reached out to us and they wanted to optimize their website and the way people could find information on the website. They had a lot of FAQ, like I think more than 500. That's kind of counterintuitive pattern, because if everything is a frequently asked question, then it's everything and it's not useful. So what we applied was really optimization to the way they could search. You could ask a question exactly as you would do in natural language to an operator, and that had a deflection in terms of number of calls they received by 46%. So they target really less than that, but that was kind of surprising in terms of final objective. So this is definitely a relevant area to me. So the customer interaction, and you could even move to different departments, think about mortgage or the collection of information you need to do with your customer. In the underwriting phase, there's a lot of in and forth checking of the documents, email that are sent that are not complete. So there's a lot that could be easily automated, because they are just informative questions. So that's kind of some of the use cases I would like to share with you.
Okay, so I'm hearing particularly around customer obsession, better customer experience, quicker processing time, better customer retention, and then also a lot about knowing your customer through omni-channels, which, as everyone has gone digital, during the pandemic is even more important for, any financial institution, right? Yeah, absolutely. Those are terrific. Does anyone have examples they'd like to add to the opportunities that AI provides when it comes to banking?
Yeah, I mean, I think that any type of preemptive strategy leveraging AI, I think is ideal for banking industry. For example, detecting fraud patterns or cybersecurity attacks using real-time transaction analysis and monitoring. And I think Pamela mentioned service optimization or underwriting loans where, scanning the documents and, predicting whether a customer will miss payments or whether they will default, so preemptive strategies to be able to predict and be prepared to address some of the business decisions. I think is a valuable area for AI and machine learning.
Yeah, absolutely. So particularly that makes me think of fraud protection. So at JPMorgan Chase, we use ML for fraud protection at a huge scale. So we've been able to both decline more than 1 million fraudsters who would have been approved, and approved 1 million good customers transactions who would have been declined otherwise. So, absolutely seeing it in that area for sure. Does anyone have any other thoughts or comments before we move on?
Well, I
maybe give one example. Oh, go ahead, Wayne.
Oh, sure. Why don't you go ahead? Okay, I'll go.
So I was gonna use an example from fraud. Can you guys hear me okay?
Yeah.
Yes. Okay, so there's examples that you'll see at banks where the fraud models will be built on historical data, and one of the most predictive variables for fraud would be card present to card not present ratio, meaning is the customer historically have used their debit card with their card present, and now all of a sudden the transactions are card not present. Those machine learning models will often forecast that that is a fraudulent transaction and freeze the card for the customer, and decline the transaction. So one area, I won't use the bank, but the model risk team in March of 2020 recognized that maybe this isn't going to work well due to the pandemic, because customer behavior is going to change quite rapidly. Customer behavior will change quite rapidly, and all of a sudden customers who traditionally had card present transactions will shift to card not present. Their transactions will be frozen. Their accounts in some cases will be frozen, and it'll overwhelm the human fraud investigators at the bank, also bring kind of embarrassment to the customer and difficult experience for the customer, or just a worse financial experience or worse banking experience for the customer using their transactions. So this one bank, their model risk team recognized that this variable wouldn't be as predictive in this new environment, this new behavior during the pandemic with these quarantines and safer at home orders, and the model risk team recommended to re-estimate the model with very recent data just over the past 2 weeks, where safer at home orders were in place and customers are already transitioning to mainly card not present transactions. So that's an example of where you see machine learning models, but you definitely see some overfitting and therefore some bad outcomes, as the current and future behavior is very different than the past. And that's an example where a model risk team really stepped in to help kind of save the day and save a lot of hours for the investigators and save a lot of hours and a better experience for the customers.
Right. So how do you address that, or what are some ways to address that? So you could potentially use synthetic data, or some things along that line.
So
when you have a smaller data set to try to fit your model and not have it overfit.
Yeah, so in this case, the bank was based in the Southeast, and the Southeast had the later experience of stay-at-home orders and a later experience of quarantine. So they pulled data from Washington State, New York State, and New Jersey that they were able to pull from two different credit bureaus. And so therefore, even your own customers are behaving like 2 weeks behind New York City customers and 3 weeks behind Seattle customers and a week and a half behind North Jersey customers. And so you could say, okay, a customer in the Southeast is going to transition to card not present about 2 to 3 weeks behind these other ones. So you can pull some data from other geographies which are ahead of you in behavior and then overweight that and say, this is what we think our customers would be. So you can pull from the geographies where COVID first hit.
Right. Or I suppose you could just take that feature out of the
You could do that too. Yeah, exactly.
Right. Yeah. Wayne, you were going to say something.
Yeah, I was going to talk from the model risk management perspective, in that really more contextually in the growth of machine learning models, and I'll make this kind of fast because it's a little bit of an orthogonal concept, and that is model production is speeding up, requires more rapid validation responsiveness. So a development of agile and synergistic technologies that retain independence of the first and second lines is kind of necessary. Now we need to give some thought to how we can speed up this long pipeline, which traditionally had been tolerated, but now it's becoming decreasingly tolerable. And then there's some thought given to telemetry. For example, ongoing management of model effectiveness can be automated through telemetry and bringing in this concept of validation on demand, which we're involved in at Wells Fargo. So this is a kind of a new domain for us. It frees the validation. It frees the relationship between the developers and the validation from some of the more mundane but time-consuming tasks, relieving it to automation.
That's interesting. All right. Well, great. Patrika, could you take us to the next question?
Sure. So the next question is, what challenges do organizations encounter when implementing or actively using AI within banking? And again, we love these examples, so keep them coming.
Right. And so Jacob, please kick us off on this one.
Okay, great. So one of the there's many challenges. So one is kind of, is the performance living up to the hype? So I'll give an example of credit models where we will have logistic regression models, traditional models used for consumer underwriting, mortgage, home equity, credit card, and then we will build AI models, machine learning models, and we'll see, are these models actually going to perform better? And we really do challenge ourselves that before we switch to a machine learning model, we want to make sure it outperforms the incumbent. Outperforms not just on accuracy, but also outperforms on kind of fairness and making sure that as we test the model for disparate impact to protected classes, again, whether it's a fraud model or it's an underwriting model or it's a other type of model, we really test that disparate impact. So one of the challenges is that before using a machine learning model, are you comfortable with it over your traditional model in terms of accuracy, in terms of fairness, in terms of ethics, in terms of interpretability? And there's real challenges. So if you're going from a consumer underwriting model that has 15 variables, and you can really go through each variable and assess, does this variable have a disparate impact on a protected class? Percentage spend on groceries. That could be correlated to family size. Percentage spend on health care services. Oh, that could be correlated to age. Other variables that could be correlated to race. And that's easy to do when you have 15, 17 variables. When you have 1,000 variables, you really have to think through, how am I thoughtfully challenging these features to ensure that they really are not having a disparate impact on a protected class? Then the other part that gets quite a challenge is the reputation risk. So if you find a variable, say, for customers that are applying for a credit card that already have a debit card, let's say, and you see that customers that you have a binary variables, do they use the card, more than 50% of the time between 2 in the morning and 4 in the morning? And say you find customers that use their debit card in that window, holding everything else constant, are more likely to default, right? Or less profitable. should you use that variable? Well, that's a reputation risk question, and also just kind of an ethical question. That's first responders, that's doctors, that's firefighters, that's nurses that are maybe using that. And do you want in the front page of the paper, less likely to get a loan if you, have if you're working in the middle of the night? And so while we've always done that really well with the variables with 15 and 8, or models with 15 or 18 variables, and there is a lot of great progress on model explainability and model interpretability, including from Wayne's area from Wells Fargo, and Gus Sujanto is really one of my role models on model interpretability. But still, as you go to 1,000 variables, these ethical questions really come up. So that's one of the challenges. The other challenge, I think, is really that close partnership with IT risk. Where do they end? Where do you begin? And there's numerous other challenges, but I would really put on the fairness aspect, the ethics aspect, and then still the overfitting. Even though I think sometimes we think we solved it, the overfitting problem still comes up. And then the alternative data, I would say, again, related to a challenge, is that you might think we're all optimistic on alternative data that it'll help expand banking and it'll have less disparate impact on protected classes. But as you start testing alternative data on credit card data and rental payment data and utility payment, when it actually has a worse impact on minorities and a worse impact on protected classes, it really even makes the kind of machine learning with alternative data more complicated, when we were hoping this would give a lift to minorities, when unfortunately often the alternative data does not give a lift to minorities. So there's a lot of complicated of our heart's in the right place, but how do you develop the models that are explainable, meet our objectives on expanding our lending and really serving our populations fairly? So there's a lot of challenges.
Right, and you said that very well, and oh my gosh, each of us can probably talk for many minutes on that. What I really resonated with was the interpretability versus performance question, right? And in my experience, that's on a business by business case, right? Sometimes interpretability is more important if you, for example, need to share a reason code with a customer on a decline, or performance if it's, say, a real-time say fraud check, which might be one example where it needs to happen, so immediately, and there's not that transparency either, required or assisting there. So, so many parts of what you said we could go into, but I'm curious if any of the other panelists would like to add a different perspective.
This is Lakshmi here. Hi. I think at a strategic level, I think banks need to be more agile, flexible, and be nimble, like a fintech organization. But at the same time, they have to act like an enterprise, meaning that the regulatory compliance and privacy aware applications, and making sure there are standards and security and all of those things. I think these two are at odds. Balancing these two, balancing the offensive strategy and the defensive strategy, and adding value through that, it's a challenge, right? So it requires an efficient operating model, an excellent AI strategy, or even digital transformation strategy. AI is part of digital transformation, right? So the high level strategy has to be defined appropriately, and it requires, bringing all the fragmented data assets together to, support some of the initiatives. Strategically, all of those things have to work together to realize value from, AI ML initiatives.
Right, and it's a great point that Agile is important, particularly in the pandemic. My guess is all of our strategies changed a lot, right? And Jacob, your comment of we only promote a model if it's better than the previous, and better is defined in a very thoughtful way. Well, what does that look like over the past year? Whereas we've all talked about here, we didn't have, it was a different data set. The world had changed, right? So if you're comparing, you're using, many cases, fragmented data or even delayed data, right? And so, particularly over the past year with the pandemic, I see these challenges as really becoming more exacerbated more pronounced, in many respects.
Yeah, and what the pandemic has taught us is that instability, it's real, right? So today it's COVID, tomorrow it could be something else, global warming and whatnot. So the models need to work in those unstable situations as well, right? So banks need to plan, the risks associated with any, basically future scenarios that needs to be accounted for, right? So that's going to be extremely important.
So plan how to be nimble, plan how to be agile, knowing that things will change and will keep changing faster.
Yeah.
Right. Does anyone have any other perspectives on this one, on the challenges?
Well, I have a couple of points I'd like to make. The first one is just to add to all of the discussion that's been made about responsiveness and privacy. I think there's been a lot of attention on what the EU is doing these days on privacy applications in AI and ML techniques, and so I think that's a fertile ground for the U.S. One thing I'd like to point out with increased online activities is openness to adversarial attacks. And so one thing we need to do is make sure that whatever it is that we're rolling out as AI and ML is guaranteed from data poisoning in terms of training the model, and also for the robustness to post-implementation attacks. And so that is a framework that needs to be beefed up over time.
I'll add one more thing there on kind of building on the adversarial, is that I think there's an extra risk of implementing AI models when you're really not sure how to implement them. And so I'll give an example, not from my bank, but from another firm. A third-party vendor said, I have the best cybersecurity model you'll ever see. Machine learning, it's amazing. And the vendor said, we'll compare the customers, if the customer is trying to access their account through calling in or using their phone, we can see if they're on an Android or on an Apple. We'll compare it to what you've saved related to the customer. And we can tell if the customer is using a prepaid or a subscription, and we'll compare to what you have on the customer. And we can compare if it's AT&T and Verizon and Sprint. We can see what the customer is doing. We'll compare to what you save. And we can even tell if when they're calling, if they're moving, like they're calling from a car or a train, compared to what they usually do. And we can compare the background noise against all what you normally hear in their background noise. And this bank, not my bank, different bank, similar size, said, that's amazing. Yes, we'll buy it. Great, great, great. So they go, they think this is amazing, best vendor AI model for cybersecurity in the world. And they go and they implement it. And they go, wait a minute, we don't save that data on our customers. So yes, the customer is using an Apple. Haha, let's see if they usually use an Android. And if so, it's fraud. That bank didn't save that data. They didn't save Apple versus Android. They didn't save the prepaid versus subscription. They didn't save the background noise. They didn't save location. They didn't save velocity of the phone. And so the vendor model did not work well, not because the vendor model wasn't designed to work well. I think it could work phenomenal for banks that save that data. But this bank never asked the questions before implementation. And now they're like, oh, why do we have so many hacks, so many, fraud, so much fraud, so many people calling into 1-800 that bank or logging in with the app? Why is this model not catching it? Because the bank associates, the leadership that's involved, never thought, do we save the data that the vendor says we need to save for the model to work optimally? And here the model risk team, they didn't get involved early. Now they kind of learned their lesson. And so now the model risk team is involved in the procurement process. They're involved in the vendor selection process. They're working with legal. And I think this is really important. The vendor was not trying to be shady. The vendor was not being dishonest or nefarious. But the line of business didn't think, what do I need on our side? What skills, what data, what processes, what procedures, what infrastructure do we have to invest in first? And so sometimes I'm concerned about one of the challenges of using AI. It's not that it's a plug and play, that there's real risks. There's risk on performance, there's risk on privacy, there's risk on security, there's risk on data poisoning, there's risk on fairness. And it's a bit like giving, my 11-year-old, keys to a stick shift Porsche and say, go drive in the snow. Well, they don't know how to drive. The car might not have been built for the snow. They don't know how to do stick shift, and they can't reach the pedals. And, what process do we have that model risk teams hopefully implement where you kind of give out driver's licenses? You have tests,
Right.
and you constrain the model and say the model can't be used in these situations. Just like AVM models can't be used on rural homes because that wasn't the training data set. How to do that more and more with these AI models when they're designed for certain purposes. And if you don't have the data and the infrastructure, use them in a smaller box, tighter guardrails, and really pay very close attention on how you're using them.
Right. I mean, that's true. The flip side or the, other viewpoint is that, the best way to keep data private is to not collect it. Right. So if you don't have that data, I can tell you it's going to be completely private because I don't have it. Right.
That's true.
So, there's two sides of that discussion.
Data minimization is ideal. I want to add the regulatory perspective here as well. I mean, SR 11 addresses the model risk management, but the regulations are still evolving. So, there is a need to self-regulate, in some cases because there are, sufficient regulations to address all of these aspects of model transparency, fairness, fair lending practices, and all of those things. So I think it's also important to self-regulate or have policies that ensures that these solutions are privacy aware and they adhere to the policies. So that's an important aspect as well.
Yeah.
It is important. I mean, so the European Union last month in April, 2021, proposed the Artificial Intelligence Act, right? So building fences around and guardrails around the uses of tech, make it more ethical is the good part, but for firms like ours, likely making it more challenging. So you have, a gated fence of EU data and users and models for them, and a gated fence of non-EU data and models for them. And, my belief is that this will follow the GDPR sort of growth path, which is, was introduced in Europe, came into effect in 2018, and then became a model for the new global standard. So, I'm curious on your all thoughts of that, because as we know, financial services is regulated, and my view is AI will become more regulated, and I very much anticipate this coming, and it's already in my plans.
Yeah, I would agree from Region's point of view. We of course read through the RFI on AI and the 17 questions there, and provided our feedback through various industry bodies, and then of course on the EU guidance, and they have a broader definition of AI than I think many banks do. But we're going through that, and to your point, just like GDPR, we think what's coming out of EU will probably be implemented in California and then New York, and then before you know it, in most states in our footprint. And so we're preparing for that. Our AI, the head of AI risk, who I meet with every day, more or less, and he rolls up to me, and he has a great team, and he's going through with his team this legislation as well, or not the guidance from Europe, as well as the kind of what's going on in the US on the request for comment there. And I think that's very important. This is a quickly changing place. I think the data minimization fits in that, there's gonna be a lot of risks here, and we have to be thoughtful, what risks are we bringing on ourselves on some of our actions? And then the big part is, if you're hiring data scientists right out of grad school or right out of an unregulated industry, training them. We at our firm, we do a lot of rotations. So many data scientists work in model risk, whether it's for 3 months or a year, there's different rotation options. And so I'm very lucky that our firm, the head of model platforms, used to work in model risk. The biggest leaders in data science used to work in model risk. A lot of the compliance team they used to work in model risk. And so I think one thing to get ahead of this is to really ensure your data scientists, whether it's through training or experience in model risk, really have are prepared for this more and more regulated and controlled use of AI.
Right. I love that idea of doing a rotation through model risk. That's fantastic. So, I'm looking at the time. I know we have a couple other things to get through. Patrika, can you please kick us off on the next question? And Lakshmi, I'd love to hear your perspective on that first.
Sure. So the next question is, has COVID-19 changed anything about banking? If so, does AI factor in anywhere?
Yeah, it's a great question. I think COVID-19 has changed so many things, not just in banking, across multiple industries. I think the term unprecedented is no longer valid. I think we should anticipate, scenarios like COVID-19 taking place in the future. And, with COVID-19, customers' behavior has changed significantly. Digital banking, as Michelle, as you were saying, omni-channel is becoming important. So understanding how the customers' behaviors have changed recently and tailoring to accommodate their, behavior and their interest and, engage with them in an appropriate manner is extremely important at this time. I think that with the COVID-19, there's a lot more collaboration happening even in large organizations because you need to be more nimble, more agile. So the traditional, more disconnected type of policies don't work anymore. So even the risk management department or the compliance department, they also need to be more nimble and agile and partner with other business teams, right? Making sure that they're achieving the business goals, right? So there's, I think it has basically improved collaboration and partnership within the organization. And COVID has accelerated digital transformation because there's remote work and, other types of virtual use cases and so on that are becoming integral part of our day-to-day culture and day-to-day activities. So I think COVID-19 has made us more nimble and agile. It has, taught us that nothing is unprecedented. You have to anticipate these risks happening in the future. And it has accelerated digital transformation initiatives within the organization. And it has significantly changed customer behavior. So it's important to, appeal to the new customer behavior, all of those changes, not only in banking. I think this is happening across multiple industries.
Yeah, definitely. I mean, I'm also seeing that customer migration to digital continues. So I focus on digital at JPMorgan Chase, and we saw in Q1, half of the new checking accounts were opened up digitally, and that's up 10% year over year. So still seeing, significant growth there. And, it seems, I believe it'll be a permanent transition. I know, for example, my mother, would always deposit a check in person, and now she discovered she can do it on her phone, and she likes that, and she'll do it in the future, right?
I'm going to add to this point that, there's more awareness to me. It's accelerated in the awareness phase, and also, and created also the need to democratize AI and the application of AI. Because if you think that, the innovators or, the pioneer, big banks, they were ready, right? So, and it was like they had the right environment. They could just, modify slightly the strategy, but they had all the weapons in their arsenal, right? That was not the case for small companies, for example. And I think that, they understood that without AI, they couldn't survive. That was the lesson to me. And also the need to democratize AI, to commoditize it. It's no more the time to experiment, but just to use to solve concrete problems. I think that was kind of lesson, broadly speaking.
Yeah, right. So what we're going to do is go to our last question on forward looking, and Patrika will kick us off, and we're going to get Wayne's perspective and do a quick go around on this, and then try to save at least 5 minutes for questions that Patrika is going to pull off the board for us.
Thanks, Michelle. Our final question is, where do you see the future of banking headed over the next 5 years?
Well, that's a very broad question. Since banking will follow human behavior, as virtual technology expands, commerce will follow it. But some folks are going to be left behind, technically speaking, either in more rural communities or simply by choice. So financial services has to expand to keep the customers, and it may take the form of more regional financial services or financial services with specialized technology, or just general growth. I've seen a growth of both types where I live in the San Francisco Bay Area. Nevertheless, I've seen the same banking products offered to customers for decades. But those products have assumed some pretty impressive new features with new vulnerabilities and risks to manage. It's those collateral developments where the greatest attention has been on updating risk management practices. And so to me, two developments moving forward seem to be first, with those new collateral technologies, and second, new forms of adversarial attack on those technologies, which could result in access to bank assets. And as a risk manager, I'm most interested in the latter development. So first, the more effectively traditional human activities can be replaced with those collateral activities as with auto decisioning or even account logins. The likelier adversarial attacks will bypass traditional security challenges, take bank assets, potentially corrupt the modeling infrastructure for long-term effects. Those are things we want to avoid. They could take the form of seasonal increases in unusual bank activity or short-term service and online automated activity, otherwise known as bot activity. And there's been a long-term growth in events like those. This is nothing that surprises us. What catches us off guard is when we don't have the mechanism in place to identify those things. So this is where the idea of adversarial machine learning becomes important. Not only do we want to protect model training data from external poison attacks. We talked about this earlier in response to another question. But we want to train the machine to become robust to attacks on its integrity. We want to make sure the models are adaptable to rapid changes in adversarial attacks. So in general, I guess that's kind of a narrow slice of the pie as to where do I see the bank going in 5 years. But I see the future of banking heading toward more governance and protection against novel attacks of new and developing technologies that support traditional products. That's my story, and I'm sticking with it.
Interesting. Yeah, Lakshmi, what's your perspective? Next 5 years.
Yeah. So COVID has taught us to be more agile and innovative, and I think that trend needs to continue in the future, whether it's delivering intelligent products or even going beyond banking. Are there opportunities for products and services? For example, I don't know, money management. Maybe there are other adjacent areas where banks can really start to deliver additional value. Right, so that will be important. Automation, automating repeatable, mundane processes and achieving, agility and innovation. We talked about service optimization, so more smart services using, whether it's robotic process automation or natural language processing type of technologies. So I see all of these things, in the future, expanding the ecosystem and forging partnerships and identifying, products and services that are not just in the banking space, but moving into adjacent spaces. I see all of this in the future, but in order to achieve that, they have to, banks have to make sure that, they have the strong technology core to support it, right? So being able to take the machine learning and artificial intelligence models to, production and leveraging it, embedding it part of the applications, business applications, right? So, so it's, that machine learning life cycle, has to be more agile and nimble, and the time to market should be addressed, right? So with all those things, and of course the defensive strategy side of risks and regulation taking into consideration. I think AI can even help, in managing risks and, responding to regulations and so on. So that's what I see in the future.
Yeah, I particularly see fairness and bias management coming to the forefront, much more so in the next 5 years on top of all these other comments. So in 30 seconds, Pamela and then Jacob.
Yeah, so to me, kind of different perspective. The first one is that if I look ahead 5 years, I think that AI will permeate entirely the operations, right? So not specifically to some department, but that will really be part of the organization. And I'm imagining a future where like the AI department is like IT or like HR, so will become a facility stuff. That's kind of where I'm figuring out we will be. And when it comes to technology specifically and AI for banks, I think that AI will definitely help in reducing the churn rate in terms of customer. And the other comment I have is I think that there will be also a better way to collaborate human technology. As for today, there's still some skepticism. And I think that the reason is that we are trying to make machine think as human, but moving forward, we will think as machine to make to make results better, right? So, or to survive. So I think that, moving forward, it will be a trade-off between the two entities, the human and the machine.
Right, right. Jacob, what are your thoughts?
So on the future of banking, I agree with what everyone said. So maybe I'll say a slightly different angle is the future of staffing within banks. I see as more and more departments are becoming more model centric and AI centric, associates with with model risk backgrounds, modeling backgrounds, but specifically model risk backgrounds are going to be moving more and more into the line of business. So as areas, whether it's marketing or it's consumer lending, and then later on corporate lending, years later, and fraud, that so many of those leaders are going to be people that grew up in that model risk background. We're already seeing that in banking. I see that about the 25 alumni, so 25 people that are at Regions today that used to work in my team that are now, leaders in the line of business, leaders in other parts, leaders in risk, leaders in finance. I think you're going to see that accelerate, and more leaders in banking, in traditional parts of banking, are going to have a familiarity with AI, familiarity with model risk, and as those technologies, especially AI, play a larger and larger role throughout all functions of the bank.
That makes sense. So we have a couple of minutes left. I'll pull one question off the board, and that's probably all we have time for. So the question I'll pull is, what are we all doing? How are we all using AI to drive the sustainable finance agenda? Is it in your thoughts? Might it be in the future?
Well, one, I don't know if it's sustainable, but I did post in the chat an article a colleague of mine wrote called "To Weed Out Data Bias, Hire More Black Analysts." And so one thing we've been doing is that our data scientists, I think the diversity of them represents the diversity of our customers. 12% of our model risk team is African American. 44% of our model risk team is women, national origin. So I think from I don't know if it's sustainable finance, but from a diversity and a sensitivity to AI ethics and fairness, as more and more the customer base with diversity of national origin, diversity of race, diversity of other aspects.
Right, definitely. So what are others thinking about on that broader topic? Diversity, AI ethics, bias management, that sort of thing, in addition to sustainable finance?
I think, so the systematic risks, we need to pay attention to systematic risks. It could be that companies not having the right data to begin with. So bias is, not necessarily someone is introducing it purposely. So it could be very unintentional because of the type of data a company has been collecting thus far. right? So it could be unintentional bias or accidental bias, and it's understanding those characteristics and being proactive about it. And I mentioned self-regulation, to some extent, to monitor for data drifts and monitor for concept drifts and mathematical drifts and so on. Part of the machine learning pipeline is going to be very important. And ethics is a very broad topic, right? So the fairness is really subjective depending on the scenario. So that's why it's important to have, ethics council in an organization or chief ethics officer type of roles in an organization. And it has to be top down. It has to, start from the top and start to think about how do we think about ethics and what are some of the policies that needs to be established? How do we communicate these policies to the rest of the organization? How are those policies incorporated in the AML solutions, right? So it's a practice, and it's an excellence organization that needs to to be there, right? So to drive some of the concerns. So that's my 2 cents.
Certainly, absolutely, I couldn't agree more. So we're about at the top of the hour. Pamela or Wayne, do you have any quick adds to that?
I guess I could say that, following what Lakshmi was saying, I think bias could be latent. And what we examine as bias could be a function of the data that we have available. I think that's already been said. So some kind of standardization really is in order for the future. And that also relates to what Jacob was saying. Some kind of standardization about fairness. And we could demonstrate that by the way we hire. So that's all been said.
Hire a team that looks like your customers.
Yep.
Right. Good. And Pamela, any final words for us?
No, that's definitely true. I would like to see more women in finance, more women in AI, right? So that's kind of my hope. And this panel is really diverse, so I'm really happy with that. But that's not always the case, right? So that's kind of a lesson for us in the field.
Right. And that is a great way to wrap it up. So thank you for all your comments, and Patrika, will turn it back to you.
Awesome. Thank you so much to all of our panelists, and a special thank you to Michelle for moderating today. This has been an awesome conversation, and I can totally hear the Zoom audience giving a huge virtual round of applause. This has been awesome. So we thank you all for speaking to us today, and a special thank you to our audience for joining us and asking awesome questions. Thank you so much on behalf of the entire team here at AI4, and we look forward to seeing you at our next event. Thanks again, and have a wonderful day.